The next step is to evaluate or assess the changes in LA Gear's profitability. Typically, the first statement I have in that section is just a repeat of what happened, what we identified from above in our overall assessment of LA Gear's return on equity. Recall that overall our profit margin decreased, which we said was worse. And in terms of our industry comparison, at 3.47% profit margin, we are worse than the industry average. And here was my first sentence regarding LA Gear's profitability. One of the things you'll notice is I've said something about our sales growth. If we recall from our common size income statements and our trended income statement, LA Gear has very strong sales growth. It's up over 300% over the past 3 years. But despite that growth, our profit margin has declined. And sometimes those things do go hand in hand, because often we might find that we might be discounting our products to try to gain market share, which is something we can consider and think about later on. So first sentence should basically repeat our assessment of the change in our profit margin from above. Then we'll look at each one of the individual components. In terms of evaluating our profitability or changes in profitability, we could look at our financial ratios, our return on our profit margin, operating profit margin, or gross margin. But usually what's more useful to do is look at our common size income statement, because you recall our common size income statement was essentially calculating our profit margin for everything, because margin means divided by sales. And in this case, we took every single item on our income statement and divided it by sales. So here was our common size income statement. And now we can look at each one of these items. Let's begin by looking at our cost of goods sold. Our cost of goods sold in 1988 was 57 cents in cost for every dollar in sales. Now we're up to 65 cents. So our cost of goods sold as a percentage of sales has increased. And whenever our costs go up, we would say that's worse. And again, rising costs causes our profits to go down, so we would say this contributed to the decrease in our profit margin. Compared to the industry, we're at 65 cents in cost for every dollar in sales. The industry is at 60 cents, so we are worse than the industry average. Selling and general administrative expenses. We were at 23 cents. We are now up to 26 cents for every dollar in sales we're spending on selling general administrative. So our SG&A expenses have increased, which again, it's bad news, so we're worse off. And again, higher cost contributes to a lower profit margin. Compared to the industry, we're at 26 cents for every dollar in sales. The industry is at 23 cents, so we are worse than the industry. Depreciation expense, pretty minor, but what's happened there? It's gone from 0.2 to 0.38, so it has also increased, which the evaluation again is worse. And whenever costs are going up faster than sales, we would say it contributed to our falling profit margin. And compared to the industry average, we are at 0.38 cents. Compared to the industry of 1%, we are in this category better than the industry average. Interest expense as a percentage of sales. We were at 1.83%. We are now at 2.05%. It has increased. Again, increase in expenses, that's worse. Increase in expenses contributed to the falling profit margin. And in terms of industry comparisons, we are higher or worse than the industry average. The only bright spot we have, or seemingly bright spot, is tax expense as a percentage of sales. Our tax expense as a percentage of sales was 6.8%. Now it's down to 2.2%. Our tax burden's gone down a lot. But that's really not great news. I mean, sure, we'll put our tax expense decreased, but in terms of evaluating it, I'm thinking maybe we're not clear, because our question is, have we got better at managing our tax liability? In other words, are we better at shielding our taxable income? Have our tax rates gone down? Or is it just the fact that we're paying less in taxes because we are less profitable? And I've got a feeling that's going to be the case. In any event, in terms of our impact on our profit margin, almost 7 cents of every dollar in sales before was going to taxes. Now it's down to 2 cents. So that would have all by itself improved our profit margin. So that is an offsetting factor. And we are better than the industry averages. We talked about the tax rate. Let's go ahead and calculate our tax rate. We can calculate our tax rate by simply taking our taxable income of $15,000, dividing it by our tax expense of $15,000, dividing it by our taxable income. Our tax rate right now is 41% in 1988. It had dropped to 40% in 1989, and then down to 39% in 1990. Remember our progressive tax rate schedules from Chapter 2? Typically, as companies' income goes down, they end up in lower marginal tax brackets, and that's what's the case for LA Gear. So the tax rate has decreased, which whenever our tax rate goes down, that's certainly better. The lower tax rate would have helped to contribute to, offset the decrease in our profit margin. Lower tax rate means lower taxes, which would have meant more profitable, and overall, remember, our profit margin decreased. So this would have been an offsetting trend. In terms of industry comparisons, we can calculate an average industry tax rate by taking its average tax expense, dividing by its average taxable income, and the industry has an average tax rate around 49%. So we are better than the industry as a whole. Now that we've identified the changes or what has caused our profit margin to go down, and again, what's caused our profit margin to go down? It would have been these three items: our cost of goods sold, SG&A, depreciation expense, and interest expense, all as a percentage of income, have increased. So those were the four contributing factors, and we had two offsetting ones, which were lower tax expense as a percentage of sales, again because we're lower profitability, and a slightly lower tax rate. So next step, we need to put this into a written format. Again, first sentence, talk about the sales growth your company has, and then repeat our sentence regarding our profit margin. If we want to look at that sales growth, we can see that on our common size and our income statement trend or our income statement itself. We can see in 1988, sales were $223 million. By 1990, 902. So that they had gone up by, and again, we can look at our trend statement. We would have said our sales went up by 175% in the first year, 46% in the second year, or if we had a baseline trended income statement, we would have anchored to column B, which was our 1988 sales, and we would have seen it was a 300% increase in sales, and again, as we found earlier, a 42% increase in net income. So net income hasn't gone up as fast as sales, and we would have had a decrease in our profit margin. Cost of goods sold went up faster than sales, and sure enough, the same thing we found in our common size income statement. So let's go back to our write-up. After our sentence discussing what happened to our profit margin overall, I want a sentence telling me what contributed to it. Contributing to this decline is an increase in cost of goods sold, an increase in SG&A, an increase in depreciation expense, and an increase in interest expense, and it's important to note that these were as a percentage of sales. Partially offsetting, that was our lower tax expense as a percentage of sales, and we could throw something in there about our tax rate, or we could talk about that later on. So overall, what happened to profitability? It declined. Which factors contributed? Which factors offset? Okay. After we do that, I want a sentence on each one of these items. Let's begin with our cost of goods sold. And here's our sentence. Cost of goods sold increased from 57.7% of sales to 65.6% of sales, and is now higher than our industry average of 60%. LA Gear may be facing higher product costs, or we might be discounting in pursuit of market share. We really can't tell from our information here. We've just got limited financial statements. We don't know what's underlying the numbers, but it could be either one of those things. Next, we want a sentence on the next item, which was our selling and administrative costs. SG&A expense increased from 23% to 26%, and it's now roughly in line with or slightly below the industry average. So we talked about cost of goods sold and selling and administrative expenses. We also need to mention what happened with depreciation expense. In this case, also typically what we can do is we want to tie our depreciation expense. It's usually related to our fixed assets. And you recall that LA Gear experienced an increase in fixed assets over the past 3 years, but fixed assets account for less than 8% of LA Gear's total assets, which is fairly different than the industry as a whole. Our low fixed assets as a percentage of sales suggests that, much like Nike, we don't make our own tennis shoes. LA Gear outsources and has their shoes made to order. If we were actually a manufacturing company, our fixed assets would account for a much larger portion of our overall assets. So we've talked about the higher cost of goods sold, selling and general administrative expenses, and depreciation expense. Now we need to comment about our interest expense. And our interest expense had increased slightly from 1.8% of sales to 2% of sales. And again, we can see that on our common size income statement. One of the things that we want to do when we look at our interest expense, typically if we see our interest expense go up, it's quite often due to the fact that we have had an increase in debt or financial leverage. In this case, our financial leverage has decreased over the past 3 years, as we can see on our ratio tab. Again, our asset to equity ratio has gone down. We had $1.97 in debt for every dollar in equity. Now we have 70 cents in debt for every dollar in equity. In absolute terms, our line of credit has gone up from $61,000 to $94,000. But again, recall that our sales have tripled. Our assets have almost tripled. They've gone up by 2.5%, and yet our line of credit has not increased by as much. One of the reasons we're going to find that we're likely facing a higher borrowing cost is because we're experiencing some liquidity problems and some financial distress, as we'll discuss later on. But try to relate changes in interest expense to changes in financial leverage. Then finally, we want to discuss the offsetting factors. The fact that our tax expense went down, it decreased from 6.8% to 2.2%, and that's due to our lower profitability and a lower average tax rate.